Hello, everyone, and thank you for joining us. My name is Amanda Kramer, and I am the Alumni Engagement Program Manager at the University of Colorado Boulder's Leeds School of Business. These are certainly trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights for life during and after the COVID-19 pandemic. Today is the first of 8 webinars in this COVID-19 related webinar series. To view upcoming webinars, please visit our website at colorado.edu/business/alumni. Click the drop-down arrow and click Attend Online Webinars. For today's webinar, we're excited to have Colorado Law Associate Professor Sloan Speck here presenting on Taxes and the CARES Act, Opportunities and Pitfalls. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Sloan, please send a question through the chat interface. We will monitor questions as they are submitted, and Sloan will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with the survey link and supplemental resources from today's presentation. Now, I'm excited to introduce today's speaker. Sloan Speck is Associate Professor of Law at the University of Colorado Boulder's Law School. Professor Speck's research interests are in tax law and policy, with an emphasis on corporate and international tax, legal and business history, and the ways in which taxation informs relationships between state and society. Before joining Colorado Law, Professor Speck taught at NYU School of Law and practiced in the Chicago office of Skadden, LLP. Professor Speck has a JD from the University of Chicago Law School and an LL.M from NYU School of Law. Welcome, Sloan, and thank you so much for being here. I'm going to hand the webinar controls over to you now.
Thank you so much, Amanda, and thanks to everyone for joining on this really, really snowy Thursday. So my talk is Taxes and the CARES Act, Opportunities and Pitfalls. And there are some opportunities, and then there are also a bunch of pitfalls. So that's the weight is probably more towards the second half than the first, the stuff after the colon. All right, so some themes from the CARES Act from a tax perspective. There's a lot there. There's a whole lot in the CARES Act to unpack. And what makes it even more complicated is that everything is kind of interconnected. So the overall theme that I want to emphasize just how complicated this new law is and how much work it's going to be both for the government and the private sector to put all of these provisions into effect in the best possible way for the American people. So my topics today, I've got 3. 1,200 big boys, I'll explain more in a moment. Putting America back to work with a question mark at the end. And Potpourri. So 1,200 big boys. This is a reference to a Futurama episode from the early 2000s that was a parody of the 2001 Bush stimulus payments, the $300 that folks got via mostly check, almost exclusively check, to respond to the dot-com bubble bursting. Then this policy was reprised in 2008, again by the Bush administration. The payment jumped to $600 per person. And today we've got a similar kind of stimulus, direct stimulus payment to people, to individuals. Now it's $1,200 per person. So we're doubling each time we do it since 2001. So 1,200 big boys, that's the $1,200 that many Americans received in their accounts, their bank accounts yesterday, and that others will receive in the coming weeks and months. So these are known as recovery rebates. Colloquially, the IRS calls them economic impact payments. That phrase alone should indicate why the American people tend to be fairly skeptical of what the IRS is doing. I want to, however, emphasize that the IRS has done a great job, from my perspective, in getting this money out to taxpayers in their pockets as quickly as possible. So these are essentially advance refunds, is the way that one could conceptually think about them. They're not taxable. It's like you're getting a refund of taxes you paid, or hypothetically could be thought of as paying, just money in your pocket to spend without any further kind of tax consequence. And the goal for these recovery rebates was to get cash out to people as soon as possible. And again, amounts $1,200 for one person, $2,400 for two, plus $500 per child. There is a limitation. The amount phases down over certain income thresholds and is eliminated over certain higher income thresholds. Total cost for this program, $270 billion, not a small piece of change to spend responding to the coronavirus crisis. So why would the government do this? Why put all this money out there? What are the possible effects of these recovery rebates, this cash going into taxpayers and other folks' pockets? Well, one possibility is that these are emergency funds. So we are under an unprecedented and incredibly rapid crisis. It's been incredibly dislocating for a really, really large number of people. We're seeing record unemployment numbers, up to more than 20 million as of this morning. So the goal is to get cash out as quickly as possible because people need to bridge this gap in kind of their economic lives. And Treasury is the entity that's been tasked with kind of getting this money out to folks. And when I saw this coming down the pipeline, when I saw the Senate proposal and the law that President Trump eventually signed, I was very skeptical because Treasury in the past, in 2001 and 2008, for very similar types of payments, did not get cash out as quickly as it probably needed to. So the idea for both 2001 and 2008, the payments to individuals were too little, too late to have any really substantial economic effect. But this time, Treasury has really stepped up to the plate. And I want to really emphasize what a great job folks at Treasury and IRS have done in getting money out to people in less than 3 weeks in some cases. And really, really stepping up and kind of pushing this cash out to folks. One quirk about this process is that it's not just Treasury. And Treasury actually has reached out to Social Security, to the Social Security Administration, and really partnered with them to reach folks who otherwise are under the radar from a tax perspective. So these are folks who are on Social Security, who are older, who are retired, maybe not income tax filers, but still entitled to this payment. And Treasury partnered early on with the Social Security Administration to get folks their money without any action on their part. Second, yesterday afternoon, Treasury announced that it would do a similar thing, again, working with the Social Security Administration, to push cash out to folks who are on disability, on supplemental security payments, to get them their recovery rebates as quickly as possible. This is a really wonderful move, a coordination between two agencies who have kind of been firewalled from each other in the past. And this has really, really benefited the American people, especially those who are most vulnerable. Okay, so emergency funds is one possible reason for these payments. Another reason is these payments are intended to stimulate demand. They're intended to get people out there in the market buying stuff, jumpstarting the economy, preventing a recession, or mitigating how deep this recession is going to be. In the Futurama episode, one of the characters buys 100 cups of coffee, and that's one of the punchlines for this parody of the Bush stimulus payments. But that's exactly what folks should do with this money. That's what the government kind of wants them to do. Pump that cash back out in the economy, stimulate demand, get the economy going again. Obviously, this can't happen until the economy reopens a little bit more, but that's the hope for these $1,200 payments going forward. I do want to point out, though, that this type of transfer is not necessarily the best way to stimulate demand. For example, food stamps, $1 of food stamp spending, this is kind of a higher end estimate, but might generate $1.75 worth of consumption in the economy. This is kind of additional tiers of consumption, economic activity that's generated by that $1 of food stamp spending. Checks to everybody, maybe 20 cents of spending. That's a lower end estimate, but that's not an unreasonable estimate. So the kind of rough rule of thumb, I think, the way that I'm thinking about it currently is for the stimulus payment, maybe a third is going to go towards actual spending, a third probably will go to savings, and then a third will go to repaying debt, which you can think of as another form of savings. It's repaying the consumption that you engaged in the past. It's not future consumption. So whether these funds have the kind of demand stimulus effect that one would hope for, we will see going forward. A third effect, these are redistributive payments. People who are high earners are going to get less than people who earn kind of a middle class, upper middle class, or lower amount. So if redistribution is one of your goals, these payments do accomplish that to some extent, although again, not to the same in the same way as a lot of other types of programs that were in the CARES Act, so unemployment and food stamp benefits. Two other possible effects that may be like less savory. One is there are special interests involved. So one potential interest group, there are a bunch of folks who get their tax refunds on prepaid debit cards. And those are relatively costly means of accessing this money. So PayPal, other financial institutions that do these prepaid debit card type of things, they were heavily invested in these types of payments. A final element is politics. So you may have heard that if people are getting physical checks, our president's name is going to appear not in the signature line, but in the memorandum line for those checks. And that actually required a pretty substantial amount of work to reconfigure the printing process to permit that type of signature. And this just emphasized that these payments are touching many, many people's lives in America. And people will remember the fact that their lives were affected by this particular program. So politicians are highly invested in making sure that those potential voters remember this money when it gets to be November of this year. All right, topic 2, putting America back to work with a question mark. There are a bunch of things in the CARES Act that are about supporting employment and keeping people in their jobs during this crisis. And these programs, they've had some effects. Obviously, they're not complete. We saw massive unemployment numbers, unprecedented unemployment numbers. But I want to touch on kind of the tax aspects of these different programs. The most important of these is the Paycheck Protection Program, which has a $360 billion-ish cost. It's meant to pump almost $350 billion worth of loans out into the economy. These loans are sometimes referred to as GROANs, grants plus loans, because these loans to small businesses will convert to grants over time. I've been pushing LANTs because they're really loans that become grants. But actually, nobody likes that term. So GROANs is what we're stuck with. So this money that people are getting, the small businesses are getting, that is effectively going to convert to a grant. It can be used for payroll, it can be used for benefits, it can be used for a bunch of other things too. Interest, rent, utilities, those are all allowable uses under this program. And to get your loan forgiven, 75% of your current kind of employee's compensation has to be maintained and kind of paid for with this loan money that becomes a grant. But there is a 25% kind of implicit slush fund that can be used for these other items, interest, rent, utilities. So I do want to point out that this is about supporting payroll, but it does essentially permit up to a 25% payroll cut and still keep you inside the forgiveness part of this program. In terms of taxes, this is for me the most important and interesting issue in the CARES Act. When these loans are forgiven, contrary to the typical tax rules, there's no income tax consequence. These are grants, they're essentially going to be received tax-free. The question is whether there are any collateral consequences. And the most important of those is that for the payroll, the salaries that are being paid, the wages that are being paid, the interest, the rent, utilities, will there be a corresponding tax deduction for those items? Nobody knows the answer to that question yet. There are folks on both sides, and we are all waiting with bated breath for IRS or Treasury to come out with some guidance that resolves this really critical question. So there could be other potential collateral consequences. There's a bunch of coordination with other discharge of indebtedness items. But there is a morass of income tax consequences, many of which are unknown and unsettled with respect to the Paycheck Protection Program. There are kind of 3 other, and I'm going to focus on just 2, tax-oriented provisions that are meant to support employment throughout this crisis. The Employee Retention Tax Credit is one. Payroll tax deferral is another, and there's a third that's not from the CARES Act, it's from the Families First Coronavirus Response Act, but it's a bunch of credits for the expansion of FMLA and sick leave. And all of these tax benefits are being implemented through the payroll tax system, which historically has been thought of as kind of a stodgy and sleepy area of practice, not a lot of cool issues, not really dynamic, not a lot of planning. Now it's become this like, turbocharged, exciting area of practice. Everybody's trying to get into it. So it's been a kind of a sea change in terms of how practitioners have approached these types of topics. The employee retention tax credit, this is essentially a $5,000 cash benefit per employee. It's in effect a 50% subsidy for wages that are paid. These are kind of maximum amounts. And it's a relatively low dollar item in terms of its overall cost to the federal government, projected to be $55 billion worth of spending, much lower than the payroll protection program, much lower than the recovery rebates. This is chump change compared to the other programs. But this is the fallback. Many of you have probably heard that the Paycheck Protection Program ran out of funds as of this morning. Well, if you're looking for other relief, this is one place to go. And in fact, you can't claim the employee retention credit if you also take one of the Paycheck Protection Program loans. So, so this is going to be the backstop for that if no more funding is available for that program. The downside of the employee retention credit is like super complex. There are a bunch of gating requirements to get into this program, and then actually doing the calculations, figuring out how to get cash into your pocket today requires a bunch of kind of arcane interpretation of administrative guidance and legislative provisions. They're going to be overwhelming for a lot of folks who are actually running these small businesses. So it might be a bonanza for tax advisors. It might be a really fun new area of practice. But for folks who actually want this money, it's just going to be another pain in the rear to kind of figure out what exactly the landscape looks like. All right, the next item I want to talk about, a final item in the Putting America Back to Work section, is payroll tax deferral. And this is a benefit that is actually available really, really broadly. This is one of the most expansive benefits that's been put into place through the CARES Act. And it's one that was a little bit under the radar when the bill was first signed into law. And it has since then kind of become one of the headline provisions, especially for very large businesses who maybe don't want to get too entangled with government regulation or oversight, but still want to get some piece of the pie in this legislation. It also is a benefit to small businesses. So this is available very, very broadly. It's essentially is self-help driven, so it's very accessible. And what it says is that employer-side payroll taxes, so 6.2% of wages that are being paid out in 2020 are deferred, and they're payable 50% at the end of 2021 and the remainder at the end of 2022. So this isn't money in your pocket that you keep forever. It's just essentially an interest-free loan that must be repaid at the end of 2021 and 2022. This is a big ticket item. It's expected that $350 billion worth of taxes will be deferred under this program. So that's really substantial, roughly the same size as the Paycheck Protection Program when it was first enacted. And maybe there's some uncertainty about exactly what happens in 2021 and 2022 when we try to unwind all of this stuff. There is a cash flow question. Will folks have the money to repay these payroll taxes when they are actually due? There's a kind of a legislative question, a political question. Will Congress amend this repayment requirement in some way in the future? The payroll tax deferral, it's simple, it's straightforward, it's self-help driven. It, however, is not cash in your pocket forever. And in fact, the CARES Act, it's expected to produce positive revenue in 2022 and 2023. Those are fiscal years, but those are the years when these repayments occur. So this is actually a kind of a net zero cost item for the federal government. Payroll tax deferral coordinates in kind of idiosyncratic ways with the Paycheck Protection Program. It's super complicated. And what it means is that taxpayers have a lot of choices. They're going to have to make decisions. Do I want the PPP program? Do I want the employee retention tax credits? What can I get into? Can I use payroll tax deferral? How many dollars are in each pot that I can put together to make my business work throughout this crisis? These are complex questions. And again, advising is going to be super critical throughout this process, trying to figure out the right package to maximize a business's returns during this period. Finally, potpourri. So there are a bunch of other miscellaneous tax provisions that are in the CARES Act. And I'm not going to go through these in excruciating detail because they are indeed excruciating. Some of them are wish list items. So charitable contributions, there is a new $300 charitable contribution deduction available for individuals, regardless of whether you itemize or don't. That's been a wish list item, from nonprofits ever since the Tax Cuts and Jobs Act was enacted in December of 2017. There is a quote unquote technical amendment that is a fix to a typo in the December 2017 law. That's been a wish list item for those affected taxpayers for a long time. And everyone thinks it's a typographical error. It did take an act of Congress to fix it. So these are kind of wish list items, maybe less directly focused on the coronavirus. And I want to actually talk about one of them just to give an example of the ways in which this type of relief is playing out. And it's idiosyncratic and it's going to affect people really differently depending on their specific situations. So I want to talk about net operating losses. And there are a bunch of super technical, really technical changes to these rules that were enacted by the CARES Act. And the effect on kind of a bottom line sense is that some businesses are going to get money in their pocket right now. And some people will get money in their pocket in 2021. But it's going to depend entirely on what those businesses' history and current operations look like. Price tag $80 billion. So this is more the employee retention tax credit, but still not super enormous ticket item. This does not, of course, include the many hours of compliance costs these taxpayers will have to pay for to actually figure these rules out. In a nutshell, these net operating loss rules say that if you lost money in 2018, 2019, or this year, you can get an immediate tax benefit or a benefit when you file your 2020 taxes if you made money in any year from 2013 up. And again, very technical about how this exactly plays out. But I want to note that it seems weird to me to key a coronavirus-related tax benefit to people's economic returns in 2018 and 2019 before this crisis even struck. Again, this is a wish list item on many businesses' radar for a while since the 2017 tax law changes. And there's academic support for this as well. The net operating losses can act as a macroeconomic stabilizer in certain circumstances. But the way it's going to play out on the ground is going to be really idiosyncratic for each taxpayer in their specific situation. This is not the same as cutting a check to everyone. This picks the winners and losers as far as who gets the money under the CARES Act. All right, so those are my three topics: 1,200 big boys, the individual payments, the putting America back to work with a question mark. Are we really supporting employment through these tax changes? And then potpourri. There's a bunch of stuff in the tax law that is either more or less related to the coronavirus crisis, but that is a big deal for some sectors of the economy. I look forward to your questions.
Great, thank you, Sloan. And as a reminder, if you have a question, please feel free to chat us or submit it via Q&A, and we will present these questions to Sloan. So, Sloan, we received this question several times. You mentioned costs for some of these stimulus programs. How on earth will the government pay for all of these things?
That's a great question, and it's going to pay for them kind of in the usual mechanism, which is to print money or to borrow money. So those two mechanisms, the fear for both is that you'll either kind of crowd out investment or you'll generate a lot of inflation. So you might crowd out private sector investment if the government is issuing a lot of debt. And you also might generate a lot of inflation if you're printing a bunch of money. The interesting thing is that those two concerns have not been kind of first order issues over the last 15 years ago. So there's a growing consensus among some economists that maybe inflation is less of a big deal than we might have thought that it was in the past. And for that reason, now might be the time to pump a bunch of money into the economy, even if there are these kind of looming specters out there of costs later.
Okay, great. Thank you for that information. Another question that we've received several times is, how does the CARES Act work for those who are self-employed? For example, sole proprietors or gig contract workers?
So the intent is for all of these provisions to be parallel for small businesses and also for self-employed, gig economy, independent contractor type workers. So there are kind of parallel provisions for most of these programs in those spaces. The issue, from my perspective, is that there is a lot of complexity that's going on right now, and there are a lot of choices that folks are going to have to make. For big businesses like all of the airlines that recently cut their bailout deal kind of earlier this week, those folks can afford a lot of expensive advice to kind of figure out what the right answers are and to argue for the right outcomes when they're working through these relief provisions. But for small businesses, and then particularly for independent contractors, for gig economy workers, it's much harder to negotiate this landscape, and there's less advice that's out there for those folks. There is parallel relief that's provided by statute, and Treasury has been highly invested in making sure this relief gets out, but it's been slower to roll out than for small businesses and slower than for big businesses. And it's really complicated. It's overwhelming, I think, to try and negotiate this new landscape in the time frame that we're asking people to do it.
Right. Thank you. That absolutely makes sense. And Margaret has a question that stems off of that. She said, do you know if the payroll tax deferment is available to those who are self-employed?
Yeah, it is. So again, it's deferral, it's not forgiveness, but the idea is that it's a parallel provision for the self-employed as well.
Okay, great. And then we have a question from David. We've received this question from others as well. You've talked a lot about the federal government. What are states doing to help people out?
So this is a really hot area and one that's incredibly dynamic right now. So states in general tend to conform their tax collection to what the federal government does. And they do that in part because it's just really easy. So if you're a state and you have an income tax like Colorado does, it's easier to key your income tax off of what folks are reporting for the federal government because they're already doing the work once. Why have a separate income tax system when you can just piggyback off of the federal government? Payroll taxes collection and things like that can work similarly. So you can piggyback off of federal-driven mechanisms. So a lot of states have paralleled kind of relief on filing deadlines and on payment deadlines for things like sales and use taxes and employment taxes. They have mirrored some of the federal action and kind of pushing those deadlines out in kind of an administrative relief kind of sense. The big waves that have been felt in this space in the last week or so, 2 weeks or so, is that New York passed its budget and said affirmatively that it will not incorporate any of the CARES Act tax changes into its tax law for next year. It will pretend as if the tax law stayed the same as it was before the CARES Act was enacted. And New York is the first state to break with the federal government in this way. It probably won't be the last, but it has really drawn a line in the sand and saying, look, all of these federal tax breaks that are coming out, all these adjustments to the income tax base for businesses, that's going to cost us as states a bunch of revenue that we can't afford. So we're not going to make these changes. We're not going to give this relief because we have to protect our own revenues. So this is an evolving area. It's going to be really high stakes for a lot of businesses that depend on especially the potpourri type tax provisions. But it's one that's definitely a space to watch as states have to grapple with these issues going forward.
Great. Thank you for that comprehensive response. Absolutely makes sense. Next, we have a question from Michael. He said, my company was recently funded through PPP. Do you know if we are also eligible to concurrently participate in the Employee Retention Benefit Program?
So the short answer is almost certainly no. I can't really give like specific tax advice. So you need to like really make sure you know the structure of your business and your personal circumstances or your business's circumstances may vary. But in general, it's a choice. Either you get the Paycheck Protection Program or you take the Employee Retention Tax Credit. Now that the pool of funds for the PPP has dried up, a lot of people are being forced into that second option. And from my perspective, and I assume from your business's perspective as well, the PPP is much more generous than the employee retention tax credit, which is very limited into amount and doesn't have this kind of slush fund aspect where you can pay for rent and interest and other expenses out of that money. It really is more focused on supporting payroll. You got to choose one or the other. For most people, probably PPP is better if you get your foot in the door during the first run of that program.
Great. Thank you, Sloan. We've received this question several times, wondering if you know, if I made money above the threshold in 2019 and 2018, but I'm now making much less, am I eligible for the $1,200 personal stimulus?
Again, I don't know what your personal circumstances are, and I can't obviously give income tax advice. But in general, the recovery rebates are keyed off of the later of someone's 2018 and 2019 taxes. So if you filed your 2018 taxes in 2019, that's kind of the first place IRS is looking. If you had already filed your 2019 taxes in 2020, again, the due date's pushed back to July 15th. But if you were on top of things and got that done early, those folks, IRS is looking at the 2020 returns or 2019 returns. So 2020 is not going to play in. And this is a great point because there is some tax gaming that's available. If your 2019 income was greater than your 2018 income, you might want to wait to file your 2019 taxes until after the recovery rebates come through, so the IRS doesn't see that you're in the phase out or that you're beyond the income caps to receive those payments. So there is an element of tax gaming here too about when people choose to file their returns.
Okay. And then we've got a question here from Rich. In your third section, Sloan, what's in the act regarding retirement plans? Could you share a little bit more information around that?
Yeah, so you can basically take out a $100,000 loan from your retirement account without penalties. So this is a pretty common relief provision that shows up in disaster relief types of bills. It just gives people access to their retirement savings without paying the usual penalties for doing so. It's not my favorite relief program. People borrowing from their future selves is a recipe for the future self being a lot less happy.
Okay, thank you. And then we'll do two more questions. We have one here from Reed. In your opinion, Sloan, is the CARES Act a trickle-up policy?
There's so much going on. So is the CARES Act a trickle-up policy, meaning we expect to get more money to people who are lower earning, and then they're going to kind of push that money up to other parts of the economy. Parts of it, I guess, are. So if you're thinking about maybe the best way to approach this is is the CARES Act redistributive, and if so, in which ways? And different parts are beneficial to different people in different income areas. So I think the recovery rebates are pretty clearly progressive. Stuff like the airline bailouts and the large business bailouts, some of that might be progressive. There are a lot of people who use those types of transportation services and need them to exist going forward. But it's also going to benefit the managers of those companies to some extent. There are limitations on share buybacks to try and prevent benefits from going to shareholders. I'm skeptical as to whether that's going to have as much punch as people maybe think. Then the potpourri type tax provisions, a lot of the business tax changes that were kind of miscellaneous, those are going to benefit certain sectors more than others and certain taxpayers more than others. So the changes, there's an individual excess business loss provision, there's an interest expense limitation change. And those two provisions working together are thought to be substantially beneficial to the real estate industry. So, that might be a particular beneficiary of the CARES Act that's not a broad-based benefit.
Great. And then our final question here is from Michael. Could you recap or re-emphasize what you see as the biggest pitfalls of the CARE Act to conclude?
Yeah, so I think the biggest pitfalls are choosing a path, a particular type of relief now, and then learning later that there was another path that might have been better. So in choosing between Paycheck Protection Program, Employee Retention Tax Credit, like making those choices now, who knows what the landscape's going to look like in the future. There's a bunch of guidance that needs to come out. But there are certainly people who are taking PPP loans now, and it's possible that might look a lot worse than the employee retention credit for certain folks in certain circumstances. So there's a lot of commitments that are going to be made now that will have lasting effects later. And I think getting advice out is really tough right now, given the evolving state of guidance and the costs associated with getting that advice from people who are really well versed in this area.
Thank you for that recap, and thank you so much to everyone for joining us for today's presentation, and a special thank you again to Sloan for this great information. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation. To view upcoming webinars as well as previous recordings, please visit our website at colorado.edu/business/alumni. Have a great rest of your day and go Buffs!